Not all numbers are born for the balance sheet. Some are born to bring a smile. Some usher the future. Some make you stand tall. Some numbers light a fire and fulfill wishes. Some spoil you silly. Some echo joyful shrieks. Some numbers have smiles written all over them. Some make the planet happy. Some make the planet healthy. Some numbers rise against all odds. Some are made for dreams. Not all numbers are born for the balance sheet. As we spread our wings globally, we at Mahindra believe that the numbers we are most proud of are the number of lives we have touched. Mahindra, together we rise.
India's economic architects, together on one powerful stage. From Nitin Gadkari to Arvind Panagaria and Montek Singh Ahluwalia, visionaries who are shaping India's future. All debating the Viksit Bharat roadmap, where legacy meets leadership. Here, the real policy playbook, finance, roads, reforms, disinvestment, nothing is off the table. The inside views, uncensored. Only at Adani Business Today, India at 100, 8th August 2025, Shangri-La Eros, New Delhi.
Good afternoon, ladies and gentlemen. A very warm welcome to you on our Market Guru series where we highlight superstar funds. It's a special day for us and an exceptional fund to be discussed, SBI Contra Fund. This is celebrating its 26th year of setting up, and in a country, ladies and gentlemen, where we run madly after growth. This is the contrarian value investing fund that has won plaudits not only in the long to medium term, but also in the short term. We will be speaking to Mr. Dinesh Balachandran. He's the person behind this successful fund and of course the head of investments at SBI Mutual Fund. Mr. Balachandran is an IIT graduate from Mumbai. He spent about 10 odd years with Fidelity in the US and then came back to India in 2011 to join SBI Mutual Fund on the fixed income side, and then started looking at equities, and from 2018 is at the helm of SBI Contra, which I just said celebrates its 26th year of existence. Mr. Balachandran is a reclusive fund manager. He barely comes on shows, and it is indeed both our pleasure and honor to host Dinesh ji. Good afternoon to you, Mr. Dinesh. A very warm welcome.
No, thank you so much for your kind words. Very happy to be here.
Okay. Let's start with the basics. As I was pointing out, in a country where we have almost put growth on a pedestal of a god, you practice value and contrarian investing, and that has delivered phenomenal returns. A 12-year SIP of 10,000 rupees, which totals to 14.4 lakh rupees in SBI Contra, is now worth 49 lakh rupees. If you were with the start of SBI Contra with a 5,000 rupees SIP 25 years ago, you've netted 2.65 crore rupees by investing just 15 lakh rupees. That, ladies and gentlemen, is fantastic growth. Mr. Balachandran, could you please explain to our viewers what, according to you, is contrarian investing when it comes to SBI Contra Fund?
Yeah. I think this is actually a very core question whenever someone asks about the Contra Fund. When you think about investing, often we create these artificial distinctions between various schools of thought, right? Where we essentially try to categorize someone as a growth investor, as a value investor, as a dividend yield investor, and so on. But when you really think about it, at the end of the day, all of us, in some sense, want the same thing. On the equity side, the reason why we invest in equities is because we want the earnings compounding. So, from that perspective, be it a growth oriented manager or a value oriented manager, we all essentially want earnings growth compounding. But the reason why you still have distinctive styles is that we don't operate in an ideal world. In an ideal world, we will get the best possible earnings growth at a very low valuation with a business model that is quite robust and run by a very competent management team, right? That is the holy nirvana when you think about investing. But we don't live in an ideal world. We live in a real world where you have to make compromises. And there, what I see is a lot of managers are very okay potentially overpaying on the valuation side because they justify it with this basic premise that in a country like India with a long growth runway, you can easily overpay for good quality businesses and eventually you will make good returns. But this is where I probably am a bit different in the sense that for me, margin of safety is very sacrosanct. I do not want to overpay for anything. Even if it is the best possible company out there, if it is trading at egregious valuations, I'm not interested. Because for me, yes, I want earnings growth, but not at any cost. I want to think about margin of safety, which means that I still need to be able to justify what I am paying for that particular company. And this is where contra fund inherently is different in the sense that what this means is that we are not chasing the latest facts out there. We are not chasing the companies or the stocks that have a very high momentum right now just because it seems to be. Am I essentially getting it with a comfortable margin of safety? What I mean by that is without making very optimistic assumptions on future growth. Can I essentially easily justify the current market value? And that is precisely what we do. And what it helps us achieve is that even the really fast growing companies in India, they don't go up in a straight line. They will sort of have their phases where the growth suddenly sort of comes down for a period of time. And when you are just sort of thinking of that stock as a momentum kind of stock, then the moment that growth fades away, you are not interested. But the problem is that while the growth was very high, the valuations became very extreme. So then, when you have to reprice the company for a lower growth outlook, the distraction in value can be quite significant. And that is what we try to avoid because we are not trying to be there when it has very high momentum. Hopefully, we'll also sidestep the part where there is significant erosion of value. And the same company, let's assume it is going through a sluggish growth phase. At that point, the market might not be so interested in it, but that is where we will potentially get interested, where we will ask this question whether the growth slowdown is temporary or structural in nature. And based on that, we try to figure out whether the odds are in our favor or not, essentially.
Okay. Mr. Balachandran, for the benefit of our viewers, would you care to explain out of 80 stocks, and this is a very wide portfolio, it's the largest amongst all value funds that I track, how many of these stocks are in the value bucket? How many are going through a cyclical expansion? And how many are possibly turnaround candidates? You could just maybe mention ballpark percentage AUM of portfolio also. That will also work.
Yeah. So actually, that's a nice way of thinking about this fund. Where when we think about contrarian investing, we have three sort of building blocks, so to speak. One is the value bucket, as you said, right, where inherently you're essentially going for companies with attractive valuations. The second bucket is the cyclical bucket, where we are specifically going for companies that are essentially in cyclical sectors, where we are expecting a significant upturn from a cycle perspective. The third one is the turnaround bucket, which has got nothing to do with top-down factors, where you're not really thinking sector-specific or something like that. You're only looking for strong companies that are going through a tough phase due to some self-inflicted wounds or certain reasons, and you're trying to see whether that can change going forward. So this is much more of a bottom-up kind of investing rather than the top-down, which is an important component of the second bucket, which is the cyclical bucket. Now, when I look at the current fund composition, at this point, close to 40 to 45% would be in the cyclical bucket, where we are essentially looking at cyclical sectors and cyclical stocks, where we are hoping for a revival in activity. So that is the mainstay of the fund right now. The value bucket, which used to be much bigger part of the fund 3-4 years ago, that has come down meaningfully, because when I look at the market right now, there aren't a lot of obvious value pockets, right? And so that percentage has come down to roughly around 15% of the fund. And then you essentially have sort of 20 to 25%, which is in the turnaround bucket. And the remaining is cash at the moment.
Okay, fair point. So that's how the fund is structured at this point of time. Mr. Balachandran, because I've been tracking this fund for a long period of time, the number of stocks has more or less doubled over the last 5 years or so. At the moment, you hold the largest portfolio in number of stocks within the value space, within the value bracket. So, is this a strategy by design? Is this something which is a byproduct of these rising markets, or are there just too many good companies in India to invest?
Yeah, I wish that were the case, but unfortunately, at this point, it's really the opposite. That is the biggest driving force here. So 4-5 years ago, it was, I mean, I can say this in hindsight, but even at that time, the portfolio composition sort of reflected this. The fund essentially had 40 to 45 stocks, because it felt like we can bet on these stocks, where the only thing we had to do was essentially be patient. We could see the potential revival in the industrial space. We could see the potential revival in many of the cyclical sectors. So it was very easy to be bullish on certain stocks. So, and the fund was also much smaller at that point. So that allowed us to have a concentrated portfolio, and that allowed us to have a very high conviction portfolio, so to speak. Now, when I look at the current landscape, the unfortunate reality is that valuations in general are not in the investor's favor across most of the pockets in the market. Valuations are too elevated related to the growth that we are likely to see for many companies. So that inherently means that it's difficult to have a concentrated high conviction portfolio at the moment. Because for even the stocks that I own in this fund, I can potentially easily make a bearish argument rather than just a bullish argument for the holdings. And a lot of it has to do with valuations, right? So one, the conviction level inherently, if I think about it objectively, it is lower because valuations are quite elevated at the moment. And two, even from a growth perspective, what is happening is that right now, if I think about 2022, 2023, of the COVID base, it was easy to paint a very robust growth outlook for India. And we could also see that nice revival in a lot of cyclical sectors, right? Be it industrials, manufacturing, real estate, commodities, name it. You could easily see a very strong revival across sectors. But when I think about the economic landscape over the last 12 months or 15 months, there has been a definite moderation in economic activity. And what that means is that, again, when you think about stocks that you really want to bet big on, it is becoming very difficult because growth outlook has gone down substantially. And it is not very obvious why this should reverse meaningfully in the near future. And from that perspective, I have to say that the conviction level in the portfolio is clearly at the lower end of the band at the moment. And then the fund size also has become quite big. And that also has essentially meant that we are owning more stocks than what we would ideally like to do.
Okay. Just a number that I'd like to put forward as far as SBI Contra Fund is concerned. In 2016, ladies and gentlemen, the net assets under management were about 1,600 crores. and now they stand at about 47,390 crores. Such has been two things, the rise in the value of stocks held, and of course the popularity of SBI Contra. It is one of those rare funds where you get about 5 to 6% of AUM as a monthly SIP, and as Mr. Balachandran mentions, it's really difficult in this kind of a market to look for value and more importantly look for contra stocks. Mr. Balachandran, to take this argument a little forward, what makes you exit a stock and exit a stock which has done immensely well in your portfolio?
Yes, yeah, this is one of those very tricky questions. When you think about it, for every stock that we add to a portfolio, we have an investment hypothesis in mind, right? So, for example, let's assume when we were buying these corporate banks 5 to 6 years ago, right now, a lot of these corporate-oriented private banks are probably complete consensus holdings, right? You look across funds, you will see these leading private corporate-oriented banks in portfolios. But 5 to 6 years ago, they were actually really shunned, where people were really worried about credit cycle. They were worried about NPAs being at very elevated levels and so on. So when we bought these stocks at that point, we had a certain thesis where we said that we will hold on to these stocks till credit costs come to completely normal levels. And in fact, when you think about how these cycles work, when you are at one end of the spectrum and you are coming back, you don't stop at the center actually. You go to the other end of the spectrum. So from that perspective, when your thesis is going right, you actually want to overstay your welcome, because you know that most probably it is not going to stop at the center. In fact, it is probably going to go to the other end of the spectrum. And that is precisely what we've seen in some of these corporate banks, where NPAs have almost become non-existent on the corporate side, right? So from that perspective, you have a certain thesis in mind, and you would want to hold on to that stock till the thesis targets are fully realized. So for us, for example, we were waiting for the credit cost to go, in fact, close to zero. And we were holding on to a lot of these stocks till that point, even as they did quite well over the last 5 to 7 years. But once our the thesis is fully realized, where you say that whatever I expected, even in a sort of blue sky scenario, if that has been realized, then you sort of get itchy, where you say that, you know what, this is no longer contrarian, this has now become complete consensus, where whatever positives I could think of, they've been realized. So it's time for me to sort of make an exit and look for something else. Because you always, in some sense, are trying to weigh ideas against each other. And hopefully you have something with much better risk-reward prospects that can replace the current holding. So that's one reason why we exit, where the hypothesis has been fully realized. We have a better idea and we want to sort of go in that direction. The second reason, which is not a great reason, but it happens, a second reason to exit is where your hypothesis completely breaks down. Now, when you talk about contrarian investing, you are inherently, in some sense, going against the market wisdom. So you have to give your ideas a long leash. You can't say that just because the stock didn't perform over a 6-month, 12-month period, that means that the hypothesis is wrong. No, you have to give it a longer leash, but you also have to be objective enough where you say that, like, if let's assume I had a certain thesis in mind for a particular stock, but clearly the way the company is evolving, it is going in a completely different direction. Then you just have to be humble enough and objective enough to realize that the thesis was wrong for this particular company, and you want to then get out, even if that means that you have to exit at a loss, essentially.
Fair point. And markets are, such an entity that they often swing to extremes, which is taking care of your first point. And of course, they also teach you lessons in hypothesis that often go wrong. Mr. Balachandran, what is the basic philosophy of your contra fund? I was checking a lot of details. You have the lowest expense ratio, the lowest turnover, just 17% of overall portfolio is churned. Your price to book is lowest amongst the value category, and also PE is just 19.3 of the overall fund. When you set up the overall structure of your scheme, what are the 4 or 5 basic parameters that you keep in mind?
Yeah, I think a lot of this boils down to actually that one central concept of margin of safety. It's probably one of
Okay.
the most overused phrases out there, but it is something about walking the talk, where whatever you do, if that concept is just fully ingrained in you, you will automatically move in a certain direction, right?
Okay.
What I mean by that is when will, like when you just think about it from a probability perspective, when are you likely to have a higher margin of safety, all else being equal? It is when the market is not at all liking a particular company or not at all liking a particular theme, because that is when the valuation is in your favor. The odds are in your favor. So inherently, we gravitate towards themes, sectors, or stocks where the market at this point, for whatever reason, is not interested. And what that means is I am inherently able to get it at a much lower valuation than the average stock out there. Right. So when you talk about the P being lower than what we see in peers' portfolio or even the price to book, it is simply a reflection of the fact that I inherently gravitate towards companies where these are not in favor at the moment. Now, what I have to worry about is whether I am getting into a value trap where it is a low P, but the low P is justified. Because it's not as if every single low P company out there is a great idea. No, in fact, a lot of them are actually companies that you don't want to buy at any P because there might be corporate governance issues or there might be structural issues from a business model perspective, right? So this is where the actual research aspect comes in. You better be damn sure that that low P is an opportunity rather than a trap. So that is something that we obviously try to do. And we try to avoid sort of these value traps or these big accidents from a corporate governance perspective. We try to do that. And thankfully, that has worked out well. But otherwise, when you're inherently going for these kind of, shunned narratives, it inherently means a lower price to earnings or lower price to book for the portfolio. And yeah, that's essentially what one sees when they look at the contra portfolio holdings.
But Mr. Balachandran, then how come 5-year returns CAGR are 31% if you are going for stocks that have been shunned?
Yeah, and this is where, let me give you a great example. So we like to think about markets both from a bottom-up and a top-down perspective. Now, from a top-down perspective, we are very, very cognizant of sectoral cycles, economic cycles, and we spend a lot of time thinking about when the cycle is in favor for a particular theme or a particular sector. I earlier gave you an example of corporate banks, where these corporate banks were available at very low sort of price to normalized earnings or price to book. For us, the key was when do you become comfortable that the cycle is going to turn, the credit cycle is going to improve substantially, and when do you really press the trigger, where you really sort of like go all in a particular theme, right? So when you do that, you're going to get great returns. When I look at the industrial space is a very interesting example. From 2019 onwards, we could see green shoots emerge in this sector. Now, industrial, unlike banking, the good quality stocks were never very, very cheap from a reported price to earnings perspective. You look at a high quality company like ABB, or you look at any of these high quality companies, even at the bottom of the cycle, on a reported basis, they still had relatively high price to earnings. But we still went for these stocks because we look at stocks on a price to normalized earnings basis, which means that we ask ourselves, this is what the earnings looks like at the bottom of the cycle. If the cycle improves, what can mid-cycle EBITDA margin look like? What can mid-cycle earnings look like? And on that earnings space, are we getting it at low double-digit multiple? If so, and we are confident that the cycle is really going to turn, we will essentially bet big, right? So when you do stuff like this, that is essentially where the returns comes from. It is not just about the fact that you're going for a low PE company. You really are trying to figure out when the earnings can sort of improve materially off a depressed base.
Okay. Mr. Balachandran, for value pickers and contrary players such as you, perhaps this is the best time. Everybody in the market is disappointed with how tariffs have been playing out, how this ongoing war is happening between India and US on economic related issues, and of course the other pains that the broader markets have gone through in 2025. For us and our viewers, please paint a picture of how do you see sentiment at Dalal Street at the moment. Do you feel very happy coming to work these days?
Yeah, this is the funny thing. Normally, when let's assume if sometime back, if someone had told me that these would be the headline news, I would have felt really happy from a contrarian perspective because it's pretty gloomy out there from a headline news perspective, right? So normally one would have felt that, oh, I'm going to get a very nice opportunity set to play in, and I can sort of be very excited about future return prospects. But unfortunately, what is happening at the moment is that even as the sentiment is negative, even as growth clearly has taken a leg down, the high liquidity in the market has meant that valuations have not really corrected meaningfully. We talk about a correction in the broader markets over the last 12 months or so. Yes, there has been a correction in many stocks. But as it really made them very attractive, my honest answer would be no. I think it's just that 2024 was the height of sort of euphoric sentiment in the market, where people felt that even 20% annual return is a very bad number. People were thinking I should make that kind of return in a quarter or so, right? That was the level of bullish sentiment that was there in mid 2024. Obviously, that sentiment has gotten, rinsed. We definitely have seen a moderation in sentiment and so on. But when I think about valuations even now, because there is still a lot of money coming into the markets, liquidity is still quite high. Valuations have not corrected as much as what I would have liked. And from that perspective, it is still a struggle. And again, this is why when I think about the number of holdings that I have in the fund, when I think about the amount of cash that I have in the fund, these are all still at much higher than average levels. I hope that changes down the line. But today, is it a fantastic opportunity for investors? At least from my perspective, the answer is no.
Right. Mr. Balachandran, we'll shift gears now. At this point of time, what would you advise investors to do in this, a rate cut scenario where 100 bips has come in as a reduction in interest costs? As a fund manager and allocator of fresh capital, where should new investors put in their money?
Yeah. One, in general, we've been championing these hybrid funds mainly because, again, when you think about it, right, equity represents the best way to generate wealth over a longer time frame. It's so hard to imagine any other asset class that even comes close in terms of wealth generation over a long period of time. So from that perspective, regardless of any view on the near-term outlook for the markets or the economy, one should have exposure to equities. So no doubt about that.
Okay.
But the problem is, I see a lot of investors who think that equity should generate linear, robust returns year after year. No, it doesn't work like that. Even if, let's assume, you get a good compounding over a long period of time, there can be years where equities can give you negative returns. And unfortunately, a lot of new investors, they don't really absorb it, they don't appreciate it. And for such investors, then our advice is, if you're new to capital markets, you may want to start your journey with a lower drawdown profile fund, which is basically a hybrid fund, where because you have a combination of equity, fixed income, and in the case of, for example, a multi-asset fund, you also have precious metals. The combination of these three asset classes inherently means that your drawdown or the percentage correction in the amount invested, it is inherently going to be low, even if equity markets go down materially, right? So because we do not have a very positive view on the markets or the economy from a near-term perspective, our advice to new investors is start off with a hybrid fund, get your feet wet, so to speak, try to understand how each of these asset classes work as people get more comfortable. In our opinion, hybrid funds, it easily makes sense over keeping money in a FD because you're at least taking some risk and you will get paid for that, right? So it's like a journey where if someone was just a FD investor, if you go from FD to hybrids, and once people become more comfortable with how these asset classes work, eventually they can essentially go into a pure equity fund as well. So that's the advice that we give for a lot of new investors at the moment.
Mr. Balachandran, it's been a pleasure speaking to you, and of course watching the fantastic returns that SBI Contra Fund has generated for long-term mutual fund hosters. Here's wishing you the best, and a happy 25th birthday at SBI Contra. Let's hope the wonderful returns continue, and that you get enough stocks in the 3 buckets that you mentioned: value, cyclical, and of course turnaround. Thank you for your time, sir.
Thank you so much for having me. It was great interacting with you. Thank you.
Yeah. Yes. That, ladies and gentlemen, was Mr. Dinesh Balachandran. He's the head of investments at SBI Mutual Fund and runs one of their most popular schemes, SBI Contra, which celebrates its 25th birthday this month. Thank you for watching. I hope you found it as interesting as we found it equally interesting to research this fund. Have a nice day.
Namaskar and greetings to all in this month of Raksha Bandhan, Independence Day, Janmashtami, Parsi New Year and Ganesh Chaturthi. May this pious and auspicious month bring good luck to all of us.